Yeah, I certainly would be happy to take a couple of questions. Let me start the discussion by asking you all a question, if I might. Why wouldn't you do this?
How long is the term of the obligation of Deutsche Bank, and what happens, let's assume it's a limited term, and what happens when it nears the end of that term and climate change risk has been repriced, and so what it's willing to offer it has changed?
Okay, so the term of the swap is literally 1 year, I think, Michael, is that right? Yeah. But it's very flexible. Actually, you can change the constituent weights anytime you want, and then clearly you can, reinstitute the swap when it expires. So, and it's just like owning the underlying stocks in terms of the economic benefit. So if I were to sell these stranded assets and receive the S&P, and let's say those stranded assets go down in price, and I reestablish the swap, I'm reestablishing at that new level. Yeah. There's a question here.
David, did you consider the energy holdings, the S&P 500, with swapping and shorting those so you get back to 10 or 15%?
Okay, I'm Bob, so yeah. We didn't, look, we tried, as I said, we tried to keep this simple. And that was really what drove the S&P on the one side and the index of coal and tar sands. And again, I would say Cambridge was very helpful in setting this up. You could certainly do something more sophisticated. If you didn't like the S&P, for instance, you could create a basket of what you think are, call them green assets, solar, wind, whatever, on the other side. I think it's actually much harder to determine who's going to be a winner than it is to determine who's going to be a loser. And so we were really interested in selling the stranded assets, but we realized that if we sold the stranded assets, that would lower our equity allocation. And so our thinking was, all right, let's receive the S&P, and that way it doesn't change our overall equity. Really, it was that simple.
Robert, we have another question right here.
Sure.
The coal thesis makes sense in the sense of increasing regulatory expense to generate coal-fired power. How do you think about reversing basis differentials in Canada as a problem with the short side on the tar assets? Because I guess in the last 3 or 4 years, basis differentials went from $5 or $10 to almost 45, and that's, in my view, I guess, driven a fair amount of the negative performance for tar sands.
I didn't quite hear all of that, but what's driven it? The natural gas?
The basis differential between Cushing oil and Canada or Alberta. So you basically have a $45 less per barrel that you're selling tar sands oil for to end users versus Cushing at $45 more than that. And differential has been increasing over the last 4 years. That's driving a lot of the negative performance in tar sands. And I was just curious, we're shorting it today. If Keystone gets built or other offtake or other capacity gets built in the next 3 or 4 years, you could see a reverse in that.
Yeah, well, I would say certainly if you look at that historical performance for both tar sands and coal, I think a lot of it's driven by the reduction in the price of natural gas and maybe some of these other things that you're talking about with respect to tar sands. But when you put on a swap like this, what you recognize that there are going to be random events that will cause it to make money or lose money. But what you're really betting on is the pricing of emissions, which is independent of those other things. So it's true that people look at coal and tar sands and say, look, it's cheap now. Why would you want to sell it today? But the point is, it may be cheap today relative to where it was a few years ago or relative to other assets. But if we price emissions appropriately, it's going to get even cheaper.
Just to ask, first of all, it was a great speech.
Thank you.
It was very clear and helpful. Talk a bit about what's in it for Deutsche Bank. Because if we see that these things are trending down, I get why they would do it if it's only a 1-year contract. But why would they show up again knowing the way the trend lines are headed? The last question, notwithstanding about $45 a share for these tar sands.
You know, it's a good question. What's in it for Deutsche Bank? And I don't know, Michael or maybe Tom. I think we went to a couple of different banks, or Cambridge did on our behalf, and our swap was so small that we had trouble getting interest. You know, they told us to go to their private wealth area, which doesn't really do total return swaps. Deutsche, I think, maybe out of a sense of you know, being friendly to WWF. They're not making a lot of money off this, that's for sure. I think they may want to market it to other potential clients. And they did kind of caution us not to spread the pricing very widely. So please keep that in this room.
But that's a question I'd like to follow up with, and I enjoyed your chat. If Cambridge, in its wisdom, were to advise all of their endowment funds and foundations to do the same swap, what do you feel the price would be from Deutsche Bank or any other bank?
Well, I don't think Deutsche is in this. First of all, you have to understand a total return swap is a very vanilla derivative. It is a derivative instrument, but you know, I worked on Wall Street for many years, and there's a lot of derivatives which are designed to make a profit. A total return swap is not really designed to make a profit. It's one of the services that an investment bank provides to its clients. And yes, there's a small fee in there, which, you know, they're not there to lose money either, but I don't think they're in it to make money. I think the bigger question that some people have raised is if CalPERS or someone decided to do this, would it have a market impact? And I imagine it might if they tried to hedge their whole portfolio, for a large number of institutions did. What I'm saying to you all is don't worry about the size of it. It's really more, you know, you probably don't have a lot of risk in your portfolio. Now, one of the things that you could think about is this can be a hedge, in which case that's how WWF thought about it. We looked at how much stranded assets do we own, we'll hedge those. You can also look at it as a money-making opportunity. You know, I think stranded assets are going to underperform the market, and I'll put a bigger size on. I'll actually create an exposure to this risk. You know, it might not work or it might work, but you can think of it that way. So I think, you know, we're not trying to have a market impact. Some people think the reason you divest of assets is because you want to drive their price down. That's not the point. You hope that rational pricing of emissions will cause the real valuation of those assets to be revealed. It's not that you're trying to move the market. So, you know, I think the liquidity of these markets is probably plenty for, you know, endowments to put on a hedge. I don't think that's a problem.
Bob, a terrific presentation. Question is, this is a very complex transaction, and the group of people that is here and countless thousands of others across the country are debating the question of ESG, SR investing. What am I giving up? What does it cost me to do it? In a complex transaction such as this, how did the board wrestle with the issue? Was this the first thing that they did? Was this the last thing? Because again, it is sort of difficult to understand, certainly in comparison of buying or selling plain vanilla securities.
Yeah, no, I hear what you're saying, and actually, this was not the first thing we did. The first thing we did is think about divestment, and you know, we asked Cambridge to, and Cambridge did a lot of good work for us. You know, they came back and said, you know, it's going to be very expensive, and so if you think about divestment of assets, that's much, much more complex than this. You have to go down to the underlying, you have to find the funds that are there. You probably have to sell any hedge funds that have these or private equity. If you have institutional managers that are managing your assets, which we all do, then are they going to create a special account for you? Are they able to do that? Do you have to, you know, redeem from those managers? It's very complicated to actually eliminate those stranded assets from the portfolio. The beauty of this structure is that you don't touch the underlying assets. It's one transaction. This is, as I said, and I'll repeat it myself, it's a very vanilla derivative security. It's about as simple as it comes. It's basically, the bank says to you, I'll take care of the buying and selling, and you get the economic benefit of that. And at the end of each month, we settle up. Yep.
Bob, you've pointed out that this dealt with a very small portion of the portfolio. What about more affirmative strategies? I guess I call them no-regret strategies in trying to invest affirmatively in solutions to climate change, whether it be, green bonds that, should be financially equivalent to other bonds, investing in, renewable energy projects that may not be correlated with equities, or low carbon indexes that are structured to track the S&P 500. Did WWF consider any more affirmative investment strategies beyond hedging this small part of the portfolio?
Well, we have, and we continue to do so. So I don't think we're done. This was one step in the evolution of our, sustainability theme that we want to build into our portfolio. So we've done a lot of other things, and we will continue to do other things. And, so absolutely. And I think, as I said in my speech, I think there's a lot to be done on the engagement side, an awful lot. And I'm much more a fan of engagement than I am of divestment. But having said that, I don't want to engage with Peabody Coal. There's nothing I can say to them. Really, the protection of the shareholder value for them is preventing appropriate climate action. So, it is what it is.
So two questions. One about where you draw the line. So what you just discussed, that you sort of drew the line with coal and tar sands. You could argue that natural gas is lower, but there are lots of pure petroleum companies that have a lot of stranded assets. So how did you determine where to draw that line? And the second question is sort of the question you asked us, was if you really believe this theory about mispricing, why wouldn't you short? If that really is the logic there, it just seems like if you follow that to its logical conclusion, you should short, because when that repricing happens, that...
You make money, yeah. Absolutely. Well, spoken like a true Wall Streeter. I had a friend, I was telling him about a stock I had, and I sold it right before it went down. I felt really good about that. He said, well, how much did you sell? I said, I sold the whole thing. He said, well, obviously you didn't sell enough. And so I agree with you. Now, having said that, and I did raise this issue with the investment committee at WWF, and they said, no, let's just hedge our assets. We don't need to, put a big position on it. And I think, again, really what are we talking about here? We're talking about trying to align the institutional values with the investment portfolio. So I don't think there's an exact science to that, how much you put on. I would definitely not say, well, you have to monitor it every day. That was one of the questions that Cambridge asked us. They said, well, if one of your managers buys another coal company, do you want to change the swap? Do you want to monitor it day by day or what? We said, look, that's not the point. We're not going to monitor this every day to make sure. And then another question they asked is, do you want to sell the actual assets in your portfolio? Now, that's maybe a slightly more challenging question. In other words, we could identify we have the following companies. We don't have the index. But our feeling was, first of all, that again requires a lot of monitoring. So if an underlying manager sells this and buys that, now we have to go into our swap and offset it. And the third thing is, and this gets back to your first question, it's not that we're trying to penalize particular companies. We're trying to hedge a risk in the portfolio, the risk of emissions being priced and that causing the stranded assets. So why did we pick coal and tar sands? Because to us, they're the most obvious stranded assets. Now, maybe there's an argument maybe here that tar sands aren't as obvious as coal. And I think I buy that. So maybe you just want to stick with coal. But the point is, you're not trying to identify all the assets in your portfolio that are stranded assets and sell them because they're evil or something. This is not an ethical or a moral argument. This is an economic argument. you have an exposure to stranded assets, find something else that has an exposure to stranded assets and sell it so that you offset that risk in the portfolio.
So thank you again for your comments, very informative and interesting. And as an investment consultant with Mercer, we've done a lot of work quantifying the risk and trying to hedge climate change risk for clients. And so we certainly agree with the position and the motivation for the transaction you described and kind of the perspective you're describing of the climate change risk. But there's another element to some of this conversation in terms of mission alignment and stakeholder engagement. Was this transaction or this discussion at the committee level something that you're communicating publicly, or do you have plans to go further and communicate that? And if any, was there a reaction to some of your stakeholders to this transaction? Did it kind of satisfy the need that many of us see to, get rid of the assets rather than manage the portfolio risk and the opportunity?
Well, let me speak personally to that. I mean, to me, I think this is a great transaction. I would love to sell it. I would love to have Cambridge and, I think there's someone from the Common Fund here. I think, if we could all do this, it sends a very strong message. And that's the important thing. I don't really care about the risk in your endowment portfolio. I care about getting climate risk priced appropriately. And so, to me, that's what it's all about. But Michael, if I can put you on the spot for a moment, do you want to speak for WWF and talk about what we're doing?
Sure. I'll just say a little bit about the overall question. So exactly what did we go through in terms of process and how did that relate to the actual swap itself? Yeah, I think that in terms of what we did, there are a lot of opinions on the board on how this actually should have been done, right? So there are a lot of opinions on one side in terms of divestment versus what we've come up with this solution. So I think that in terms of how you manage all of those expectations is very difficult, but this seemed to be a logical piece that you could put in place that did get to that one part that Bob, as he explained, in terms of coal and tar sands, the most obvious ones, and I think that they were very pleased with that. So it's a step in the direction of where we're going. It's not the final step, and it's not the only step, and we still have work to do, and we're on it. So I think this is just one thing that we're proud of.
Sure, yep. There's one over here that I've seen, okay, and one there, okay.
I just had a question. When you're setting up this swap, did you have a price point at which you think the risk is appropriately priced? Did you and Cambridge consider it? There would be at some point you'd take the swap off because it was appropriately priced at that point? I mean, I don't see that in the near term, but
yeah,
do you have a target
I hope it
line?
happens in the near term, and I would say my price point is when emissions are about in the range of $40 to $60 a ton. Then I'll say, okay, we've made a good step. One of the things that will happen is when we price emissions appropriately, we'll get a lot of information about how the economy reacts to that. And as an economist, I'm very optimistic. I think you take emissions prices up to $60 a ton, we are going to, in a very short period of time, eliminate, 80% of emissions, maybe over 10 years. There's just a lot of things that can be done. And you'll incentivize innovation. Right now we're relying on a pittance of government subsidies to generate the technology that will solve this problem. When you price it, all of a sudden you have all these entrepreneurs out there looking to make a profit by coming up with solutions. I think it's, I'm an optimist. I think it's very likely that we will solve this problem. I think technology and all of that will happen if we use the price system appropriately. And as long as we don't do it, we're getting closer and closer to that cliff. And, there is risk. I'm an optimist, but that doesn't matter. I'm still a risk manager, I still think about that worst case scenario. And so I think that is a price point somewhere around there. But like I said, we may find that it doesn't even require that. So and well, I'll be very pleased to take the swap off once that happens.
Bob, the first two-thirds of your remarks were about appropriately pricing risk or appropriately pricing carbon. How does this, I can see how the swap may be good for World Wildlife Fund. I'm not sure what Deutsche Bank sees that you don't see that would lead them to buy into it, but
well, you have
what
to
does this
understand,
do to drive the appropriate pricing of risk and carbon? Isn't this kind of a formula for an economic tragedy of the commons?
No. First of all, Deutsche is taking the other side of our swap, but they're going to then hedge it. So they're going to then sell those assets that they have bought from us, and they're not going to take this risk. They're not taking the other side of the bet, if you will. And how does it price carbon? Well, I think, first of all, it says very loudly that climate risk is a significant risk management issue. I think we're pretty close, but we have to educate the public because there's been a lot of disinformation out there. So you've got the American Academy for Advancement of Science, you've got the IPCC, you've got every scientific organization in the world that said, look, this is real risk. And then you've got all these students, God bless them, who are saying, we got to do something. What are you doing? And then, I think it makes a statement when the university says, you know what, we're going to hedge this risk in our endowment. It's a real risk. And then let's go, say, look, we've got to create the appropriate incentives. A lot of people think, okay, it's real, but what can I do? I'll try and drive less or something. Voluntary efforts are not going to do it. You've got to create the right incentives. And as educational institutions, I hope you're pounding into your students. Incentives matter. This isn't going to be solved unless we set the right incentives. And we got to focus on that. And, it's not just the U.S. problem. And you mentioned the tragedy of the commons. That is the biggest friction here. It's in no one's interest to move individually. And if someone does, when Europe goes out on a limb and says, we're going to price, and no one else does, they're hurting themselves. And I'm sure, some of the politicians will say, well, it won't make a bit of difference if the U.S. moves and China doesn't move. So we do have a coordination problem here. But I think if universities get involved, it's very helpful in that global discussion.
Robert, we've got time for 2 more questions, which
Okay.
I've got lined up.
I know I see a lady back there
And
who's
we maybe
had her
have a
hand
third. So we'll try to get through the 3 that we have remaining.
up. Okay.
Hi, thanks for the presentation. I think we've heard from a few people in the audience here that this is one approach to solving the problem. And I also suspect that we've got a number of investment managers here in the audience that are listening to this and wondering what kind of conversations did you have with Cambridge Associates about taking some of their strategies, which may be low carbon, carbon neutral, perhaps fossil free, that don't necessarily involve divestment, but it's sort of a first step in transitioning the WWF portfolio in a different direction. So I'd be curious to hear sort of where those conversations, how those conversations took place, sort of in this process that led you to going in this particular direction.
Well, early on, we talked to Cambridge about, managers who are focused on sustainability, and we made one investment a couple of years ago along those lines before we started thinking about the swap. I don't know, Michael, do you want to say anything more about that? Because you've had those conversations directly with them.
Just really quickly, the one fund that Bob mentioned was Generation, which I think some of you are familiar with. So it's been a progression in terms of how we've done this implementation. So yeah, we have looked at a proactive way of identifying with Cambridge certain options that you just mentioned in terms of how we implement this structure. But it isn't a complete piece, right? So we've still got some part of our portfolio in in funds that have this exposure, and again, that swap gets to that piece. But yes, we did talk to Cambridge about some of those options, and I don't know if Tom Mitchell, are you still? Yeah, saw you. You may want to talk.
Well, the question was, what other things have we discussed with Cambridge that we could do in our portfolio?
Sure. Well, I won't go into too much detail about what's actually in your portfolio, but we certainly talked about alternatives to looking at switching fund managers. As Bob mentioned in his speech, there was the redemption from a manager that had the vast majority of stranded assets exposure and fossil fuel exposure. They were already proactively investing in sustainable funds and have some very good managers in that realm. And currently we're engaged in, if I'm allowed to say, reviewing the policy. And really, part of this all along is, we believe, and WWF believes, that policy is critical toward driving portfolio implementation. So this step really got things going and crystallized a lot of thinking around the sustainable strategy. But we really are working deeply through the policy right now and expect this will, as you said, be an ongoing process for the coming years.
Yeah, one thing I should make clear is that it's not that someone came to us and said, here's a swap, try this. It was, okay, how can we hedge these assets? And we thought about, well, can we use futures? Can we use ETFs? Sell the underlying? This was the cheapest, after looking at all the alternatives. This was the easiest, simplest, cheapest, most flexible approach to eliminating the stranded asset risk from the portfolio.
I was very pleased to hear your comments this evening about pricing carbon appropriately. I think that's fundamentally what needs to happen. It's related to the topic of this conference, but not the main focus. I was interested in your argument against this idea of a slow policy ramp of gradually raising the price of carbon, and instead arguing for a rational expectations informed, do it immediately, make a big jump. Now, is that view of that policy approach, that immediate jump, is that informed by, does that take into account the political economy of, if you have a rapid, abrupt change in price, there will be dislocations, there will be disruptions, there will be hardship, and you have a Congress which cannot bind future Congresses. And if you have a price that goes from net subsidies today to $60 a ton tomorrow, the next Congress that's going to be elected, what do they do with that? How do we sort of navigate this I can understand in the purity of a rational expectations world, go to $60 tomorrow, or maybe now. In the world in which we actually live, with a U.S. Congress that doesn't follow rational expectations, is there a blended approach here, or do you still think that do it immediately, go for it, let's just push this rapidly?
Yeah. Well, there's a political risk. So the answer to your question is, this is the rational expectations equilibrium. It's not obviously predicated on political calculations. I'm not a political scientist. Having said that, the reason that $60 is the appropriate price is because that's the damage that's being created. That it doesn't make sense to price it at 20. A lot of economists will say, well, slowly get up there. That's slow policy ramp. I don't know what justification. The justification for the slow policy ramp, let me just clarify, is if you don't have uncertainty. If you knew exactly how much you had to emit and where you get to right before that curve, and you know what the curve is and you know where you have to be, then you get there slowly. Okay? The reason you would go fast is because you recognize there's a risk that maybe at some point, 10 years down the road or 20 years down the road, something happens if you don't create a margin of safety. So it's the appropriate thing to do. It's again, as I emphasized, it's not that you're destroying value or creating disruption by changing the price. If you change the price, people's behavior will change. They'll do the best they can. The economists estimate that the impact on consumption if we price it appropriately today, will be somewhere between 0.5% and 1.5% of consumption. The impact on prices, say for gasoline, would be, maybe 10 cents, 20 cents a gallon. That's, the truth is, if we priced it appropriately, most people wouldn't notice. It's not that big a deal. But the political realities are what they are. We've got to try and do what we can to educate the public so that they will support this, so they understand the risk. And would it be the worst thing in the world if it took 5 years to get there? I agree about the flood insurance issue. You don't want to go so fast that you pull it off. And the other thing is, it's got to be global. I would say, in fairness, many people would say, and I would agree with this, that the U.S. is the biggest problem. It's not China or India or whatever. No one else is going to do anything until the U.S. does something. But I would say that the best way to go forward is to move together. And the pathway that I see toward moving together is to start with aviation, which is a global industry. Aviation could set one price, and it would be a global price immediately. And then maritime transport would join in, and hopefully you would then negotiate everybody pricing it at that global level. It's a real governance issue, though, because who sets that price? What we really need is something like, the Federal Open Market Committee, which sets interest rates. Well, we need some global committee to set a global price for emissions. How do you get there? It's a big jump.
Robert, we have one last question, although I know that there are many more in the room, so I'm just going to hand the microphone off.
Okay.
Hi, Bob. I'm Natasha Lamb from Arjuna Capital. I so much appreciate this conversation around proper pricing. And it's something, that we've worked really hard in our investment strategy to implement. The question that I sort of throw back to you and also to the room is one of moral alignment and philosophy. And I know that the student divestment movement has been driven in large part by this sort of moral imperative. And what we're teaching at universities is there's a dissonance between what we're teaching and what's happening with endowments. And, of course, WWF is not a university endowment, but of course a very values-driven organization, I would say, from an environmental standpoint. And so what I see with the swap, for instance, is, it's a fantastic hedge, but you're also investing instead, in a sense, in the S&P 500, which is not necessarily a sustainable investment. So I would just pose that question as well. Of course, it has, in comparison to the pure stranded assets, it has a lot less exposure, understood. And then just another thought in question, sort of that I would offer up, is this idea of divestment and engagement being mutually exclusive. And I really love the divestment movement. And, with our products, we have fossil fuel free, and we have people that are invested in fossil fuels, and we do engagement. And we actually were engaged in the Exxon engagement. But it's kind of everything you can throw at it. Throw in the kitchen sink. It's political, it's economic, it's about price, it's about morals. And I'm curious if, WWF and you have thought about, yes, let's divest some of our assets, let's make that statement, and then let's engage over here.
Okay, well, in terms of the first question you raised about the S&P and it's got some stranded assets in it or something, we're not trying to be pure here. We're not saying this is perfect, and others can do something different. It's very flexible. You could put whatever you want on either side of this. In terms of the moral arguments, I guess my approach is to say, look, this isn't about morality or ethics. This is about rationality. You know, it's just a question of we're being irrational. We've got this, you know, I mean, maybe there is morality or ethics to it as well. I'm not trying to say there isn't, but the bar isn't that high. We don't have to discuss morality or ethics. It's just irrational. It's just we're taking risks we're not getting paid for. And it's not even risk on our behalf. It's our kids and their kids. And every generation, these are irreversible changes that we may be doing. I mean, you know, there's a lot of reasons not to do what we're doing. And, you know, but to me, it's just simple. If you say, just look at it, it's irrational. We're wasting this capacity of the Earth's atmosphere. And, you know, we don't know what's left. Who knows? It could be too late. I don't think so. But it could be that in 2 years we cross some, you know, point of no return. This is an emergency. This is an urgent need to take action. Now, you know, on the positive side, I think we're almost there. I do think most people realize it's real, it's caused by humans, and we have to do something differently. I think what's missing is a strong understanding of what we need to do. If everyone speaks with one voice and says, look, we just have to create the appropriate incentives globally to fix this. That's why I like, actually, Bill Gates's, you know, quote. It's just a bug in the operating system. We can fix this. It's just a few lines of code in the tax code. Let's do it, you know? And I think we just have to get that understanding. Now, there are some powerful forces on the other side, but as you know with Exxon, it's become very difficult to, you know, to be a Peabody coal company at this point. If you're, you know, if you're a serious person these days, it's very hard to be a denier. And they have a very sophisticated PR campaign, which I give them credit for, and it's terrible. But we should call them out on that, you know, and maybe we'll get this thing done sooner rather than later. Anyway, thank you.